Welcome to this special panel discussion today, which forms part of Future Generations Virtual Investment Forum. My name's James Thomson and I'm a Chanticleer columnist at the Financial Review, and I'll be wrangling today's fantastic panel featuring three of the stars of Australia's funds management community. We're joined by Geoff Wilson, who, as well as being the godfather of the Wilson Asset Management empire, is the founder and a director of the Future Generations family of companies. Can I also welcome Ben Griffiths, the Managing Director and Senior Portfolio Manager of small cap manager Eley Griffiths. And finally, please welcome Jacob Mitchell, who's the founder and CIO of global manager Antipodes. Welcome to all of you. And Geoff, if I can just start with you, please. It's been an amazing year. We've seen the panic of March and the rebound through the remainder of the year. What's your sense of where we're at? And I guess, are there any investment lessons that have jumped out in such a strange and unprecedented year?
From an investment perspective, where we've been through that tough part, it nearly seems a bit surreal in terms of what we've been through, whether just emotionally being positioned in Australia, where we had the bushfires and dealing with the smoke in all the capital cities, and then effectively with COVID, with the equity market, we had a bushfire in the equity market, with the longest bull market coming swiftly to an end in March, but resulting in the shortest bear market nearly in history, which is normally is bizarre. And so it has been a very weird year in terms of going forward. I mean, obviously the cheap money, that still seems to be the theme. Record low interest rates, pushing up valuations. There's, and I know we'll talk about it a little later, whether there is a tech bubble or not, and how we're going to deal with, or the end result from the US election, which seems to be after the first debate, it seems. It seems unreal what's going on over there. So as an investor, obviously, bull markets always do climb walls of worry. I tend to be, on the more conservative side. But looking forward, I think it'll be, it really does depend a little bit who does win the US election.
Yeah, well, we will come back to that. Ben, the word unprecedented has been a sort of catchphrase during earnings season, and I guess for every commentator over the last 9 months or 10 months now. What's your sense of what we can sort of take out of this period? Are there new lessons we need to learn from something that's been quite unusual, or have the old sort of maxims of investing stayed pretty true?
Look, James, I think, and I'm on the record of saying this with a few people actually, that every crisis, every panic, every market sell-off is different, but the playbook tends to be the same. I think if there's three things I took away from what we went through, and boy, do we go through some extraordinary turbulence, and Geoff has just touched on that. I saw a great headline that said, when two black swans collide, and you had an equity market implosion hit with an oil market collapse with spectacular results. And I think the three key things that I've taken away, and I suppose I went into the crisis having them ready. I didn't think I'd actually need them. The first thing is beware of extrapolation bias or recency. The idea that when you're stuck in one of these meltdowns, these horrific market episodes, you feel like you're never going to get out of it. We are now destined to be in a miserable market setting for years. You've got to get out of that and realise that markets do mean revert. And so beware of the recency effect. It can cloud your decisions. I think the other key takeaway for me, again, which is time-honoured, is in times of meltdown, get after stocks that are quality and good, well-regarded names, well-managed names, quality first and foremost. And the final yardstick that I will run with, and I have been for years, is always keep an eye on the price chart. Share the ASX 200 and the small ordinaries when the market was melting in March. It's amazing how both those indices were captured by a support line that came out of December 1992. Essentially, that is the long-term market bull trend that's held equity markets aloft since the early 90s. The market was tested. The last time it was tested was the GFC, and we bounced. We saw it again this time. So I think looking at price charts and being very, very aware of where support levels is critical. We saw the market touch that level in March, and within a couple of weeks we realised that was a genuine validation of that support line, and we got investing, we got spending. So they're the three things I think I've taken away.
Thanks, Ben. Jacob, how have you sort of approached the last 7 or 8 months? I guess it's been a roller coaster. Have you tried to sort of keep as steady as possible and keep emotion out of it?
Yeah, look, I think, as Ben mentioned, the crises are different, but the playbook can be somewhat similar. Investors generally got very bearish at about what a health crisis, meeting a credit crisis, what that really meant. Because I think what you were facing was a genuine seizing up of credit markets. And, we'd always, at Antipodes, we sort of had relatively good insurance against that, because we'd seen, look over the last 5 years, a lot of crowding in, a lot of lending into weaker businesses, encouraged by pretty loose policy environment. And as you know, we went into COVID with a fiscal deficit in the US, close to full employment, fiscal deficit, and pretty forgiving monetary policy. So settings were very loose, and hence there was a lot of pretty poor investing or capital allocation taking place prior to COVID. And you could see the credit crisis coming. COVID just made it happen faster. Probably, that the playbook is, well, how quickly does the policy response take traction? And I think that's always difficult. And I think from our perspective, we're probably too slow to pivot in terms of the upside. How quickly, not just the fact that the Fed was willing to socialize credit or credit risk, but also that the income stimulus was going to be spent. Like that's probably the biggest single factor that has fed into the rebound into certain equities and certain sectors in the market, has simply been those on low incomes that effectively received a doubling of their income overnight in the US actually went out and spent. Now, that's, you could say, well, wasn't that always going to happen? Well, it looks simple in hindsight, and it's certainly fed into a decent rebound. Household incomes in the US have actually grown. You're up 8% year on year. So you've had it's been a pretty interesting, a sort of outcome to have such effective policy in such a short period of time. The question, I suppose, is there any longer term cost? I think there clearly has to be, but the markets at the moment are not focused on that.
If I can stay with you, Jacob, just giving us a bit of the global view. I know a lot of fundies have become epidemiologists over the last little while, perhaps on an amateur basis sometimes. What's your sense of where we're at with the vaccine? And perhaps if you could give us a little bit of the global context, because it's important to note I'm here in lockdown Melbourne. It's a bit hard to see beyond the 5K bubble that I'm in sometimes, but there's very different paces of recovery in Asia and Europe and the US. How are you sort of thinking about that? Where do you think we're at, and are you starting to position for a reopening?
Look, I think to answer that question about a reopening, I think clearly, well, there seems to me, and based on our own internal, we're as an investment team, we have our internal expert in the area, Nick Cameron, who's well qualified to actually have an opinion. And his opinion is that we'll get this virus one way or another via a vaccine, within a normal investment horizon. With or without vaccines, we're actually just getting better at managing the impact of infections, like the spike in US infections that happened in their summer period in the South. Actually, it didn't really lead to a spike in fatalities. I think as you go through the Northern Hemisphere winter, you'll have another spike in infections. The market's sort of worried about that, but I suspect it won't flow through to a very bad outcome on fatalities. And that's just the healthcare system getting better at managing the problem. That's also a function of probably just the fact that we're starting to build up a little bit of immunity. And and then we've got the issues of better, probably a vaccine sometime next year. And I think what we see a pathway to reopening. I think it makes sense if they're very strong companies that have been hit in this environment, there's no reason why you shouldn't be thinking about investing in them. And I think COVID is, I think over time is becoming less of a health crisis. And it's really just a question of how governments respond to these infection spikes. My view is that we won't go into a hard lockdown in Europe or the US, similar to what's happened in Melbourne. There'll be soft lockdowns, but they'll very much resist a hard lockdown.
The cold, hard reality of this is increasingly governments won't have the option about going to lockdown when they can't afford it. Central banks have played and deployed almost every tool at their disposal, and governments are kind of pretty well at the end of how much fiscal stimulus they can throw at it. It's pretty well, we're going to have to evolve some strategies that just don't evolve, or that can't simply justify total shutdown and subsidisation or safety nets. So I think we're on that trajectory, and that is the reality that governments probably haven't got a heck of a lot more to throw at it. It's going to be down to personal practice, social distancing, and living with this new world. That's my belief.
Geoff, what's your sense? Does Australia need to get the borders open and move a bit quicker in as Ben points out, sort of learning to live with this?
I definitely think both Jacob's and Ben's comments that this will eventually normalise is very important. And I mean, talking about periods where there's been some extreme situations. I remember I was working in London around the time that the IRA were blowing up pubs, and they blew up the first one. And I remember then I was very young in those days and used to go out to the pub. Then of course for the next couple of weeks we didn't go to the pub. Then we eventually go back. Then they blow another one up, and then maybe it takes us a week to go back. But then eventually we go to the pub and accept the risk of going to the pub is getting blown up. And I suppose it's, as human beings, as Ben and Jacob have said, we do adjust our behaviour to cope with various things. And I mean, Ben used how we've dealt with AIDS, and so I would assume that we will normalise. COVID will be something that we'll live with. Whether there's vaccines or no vaccines, it'll just be something that we learn to live with. What
do we think comes next? Ben mentioned that the central banks are largely out of bullets. Does that put all the pressure on governments to ramp up fiscal spending? And do you expect to see a wave of fiscal spending across the globe that could keep, be a tailwind for stock prices?
You're now starting to see the rebound, the natural reaction to stimulus that was provided, whether it's interest rates artificially suppressed or whether it's government safety nets and so on. You're seeing the rebound effect of that. Money supply, what the spigots are being turned on for in a liquidity perspective. Money supply in the US was up 25%. Until on James, 25% in the last in over a period of about 6. Supply was up 20% over about 18 months. So we've had a powerful economic revival across the globe.
Jacob, are you expecting? We mentioned the election, US election just before. Are you expecting to see a sort of explosion in spending coming out of that, from regardless who wins, or almost?
Look, the only scenario where I think that happens is if there's a convincing clean sweep by the Democrats, and I think that's a low probability. I think it's going to be very tight. for what it's worth. I think it is going to be a very tight election. So that may not be great for for fiscal policy. It could be, if the Republicans control the Senate, I think they're going to be they're not necessarily going to give Democrats what they want from a fiscal perspective. So you could have more gridlock, and then you've got the midterm elections where the Senate, a third of the Senate will in 2 years, a third of the Senate comes around for re-election. So, politics is a blood sport in the US. So the only scenario for a lot of fiscal stimulus is that clean sweep where Democrats then put in place social wage. Let's call it the European version of the Green New Deal.
Yeah.
That type of spending.
But beyond that, Jacob, do you see a sort of an increase in fiscal measures across the globe? You just mentioned the spending we're seeing in Europe, and that's got a green badge on it, I guess.
Yeah.
But we're seeing other programs, including in Australia, the infrastructure programs, announcements around manufacturing and all sorts of things. Will that continue?
Yeah, I think governments are becoming a bit more pragmatic. Their central banks are telling them that they're, as Ben mentioned, increasingly out of bullets. So they've made rates low and the private sector doesn't seem to want to borrow a lot. So it's really for the government to step in and take advantage of low rates, and then hopefully do something productive when it comes to spending the money. I think in Europe you could argue that look, climate change, regardless of what your personal views are, it seems to be an off-the-shelf decarbonisation. Seems to be really fit to ticks two boxes for government, right? It's capital intensive and it's labor intensive. It actually creates jobs. An environment where we've had a big tech boom, it creates a lot of productivity. It arguably doesn't create a lot of jobs. They're looking for a policy that will stimulate job growth, and decarbonisation absolutely does that. And if you add up what the Europeans are talking about, hopefully they'll get to action. But $4 trillion over 10 years. To get to about a 50% emissions cut. Now they have an ETS, so they actually have a price on carbon. So some of this will happen regardless, and then it's up to national governments, I think, to step in to drive additional policy. We think there's the beginning of a very, let's call it a super cycle in renewable investment, driven largely because the technology is pretty competitive. I mean, wind and solar are becoming competitive base load power sources, and throw in some carbon, let's call it carbon incentives, and you can get that investment cycle going.
Geoff, if I can come to you, one of the things Jacob just mentioned there was the tech boom we're having, which is a boom in many respects, including in valuations of tech companies.
Yes.
How do you sort of assess that trend over the last little while? Is it, does it look overcooked to you?
Yeah, like from my perspective, it's overcooked. I mean, one of the things that worries me a little bit about the market in terms of there's probably a bit too much heat in the market, whether it's technology stocks or not, is hey, I do a bit of cycling, and one of the guys I was cycling with was telling me how his son lost his job, and he's 28, but and he's just been punting the market and making money, so he's going to do this for the rest of his life. Now, unfortunately, investing in the market isn't that easy. Now, we know the market over time goes up about 9 or 10% per annum, but in that, there is a lot of volatility, and so. To me, it's for a lot of people, it's just been a one-way bet, and I think we've probably, the market does have to. There has to be a washout at some point in time where the people that think it's very easy realise that it's not very easy. And I was always taught when I started in the equity market that you make your money in your second bull market. and that means you actually learn your lessons in the first bull market, and one of those lessons is the market doesn't go up forever. And of course, obviously, with record low interest rates, with companies that potentially have some growth, being the technology stocks, they've been pushed to very high levels. Now, more recently, they seem to have hit a bit of a soft spot, and my view is that there has been a lot of it's been one-way traffic in terms of people just thinking it's easy money there. So it wouldn't surprise me if those valuations for a lot of those technology companies does continue to struggle. If they have over the last sort of few weeks.
Ben, what have you made of the big explosion in tech valuations? We sort of have this sense that that fundamentals perhaps don't matter anymore, and when your assets are intangible, there needs to be a different view taken by investors. Do you subscribe to that? Are there other metrics we should be looking at with tech stocks?
The whole tech mania really, James, comes down to the market is lusting for structural growth stories, and it's not just US tech, it's Aussie tech, it's Chinese technology companies. The Chinext is actually outperforming the NASDAQ. So it's a lusting for structural growth, enduring growth, and that's precisely what tech gives you. Yes, there's no doubt about it. There's been overreaching across the board, but not everywhere. There are examples in our market. Wise Tech on sort of 47 times EV to sales, seemingly absurd, whereas you've got Tech One and on 7.5 times EV to sales. So you've got a good disparity in valuations there. Look, has it overreached? I was speaking to a fellow the other day who said, don't look at tech stock valuations through the lens of short-term valuation metrics. You need to pull the focus out and set aside your fundamental tools, set them aside. These companies are building models now, their business models, and in time you'll sit down and you can judge them by more conventional yardsticks. I found that conversation quite terrifying, actually. Because that's not how we've traditionally approached investment in any stock. But I guess what the message there is saying, pay heed to the qualitative features of these businesses, which are significant, whether it's the opportunity that they're seizing, the technology they're developing, and the people that are behind it. So it's pay heed to the qualitative aspects and visit the valuation yardsticks later. Now, I'm not so sure about that. The yardsticks, there's EV to sales and EV to EBITDA are the measures that we try and use to put some sense around a lot of it. And there are pockets of good value and attractive stocks that are on not too bad a level of EV to EBITDA. So yes, there's pockets of excess, but there's also stocks that I think if you're looking for an appropriate valuation for growth, they're still quite reasonable.
One of the sort of interesting dichotomies, I guess, at the moment is value v growth. And as a value investor, Antipodes, I know you likes that idea of pragmatic value, which I think is a nice way to think about it. But how have you sort of come at having some of these big tech names in your value portfolios?
It's probably just the observation that what we've seen and has been mentioned is this sort of desire to get exposure to structural growth, and as real rates have gone lower and are now negative, over 10 years, the US bond market is pricing in a negative 50 to 50 basis points per annum of real growth decline. Investors have simply said, well, give me growth and I'll pay whatever price I can for it. And that's across sectors. I mean, it's not just a tech phenomenon. I mean, it's PE dispersion, that the premium you're paying for the top quintile of growers versus the bottom quintile of growers has never been more stretched. Now, as a pragmatic value investor, we sort of we take the view that it's paying the right price regardless of what the growth is. So yes, you pay a higher PE for a higher growth company, and you should pay a lower PE for a lower growth company, but one's not necessarily better than the other. Now, the weird environment we're in now is that those growth stocks are just getting more and more expensive. So is there a point where you just have to say, well, there's no more opportunities left? Well, look, they get harder to find. And we've tried to manage through this environment by not being stylistically, not taking too big a bet against growth. It's difficult because the market's become extremely sensitive to growth, and growth is, the market cap concentration in the market. It might astound you, but the top quintile of growers is on a P of roughly 50. The bottom quintile of growers is on a P of 7. That relationship's never been more extreme. So like we own Facebook, we own Microsoft, but they're not on P's of 50. And we think they're very, let's call it quite resilient businesses. It's sort of, as you get into some of these other businesses, some of the SaaS companies that are very narrow, and they're competing against ultimately Microsoft, 365. And even, Office 365 has a global outage. Microsoft shareholders don't really care. It's just such a fundamental, it's just essential infrastructure.
Yeah.
So, paying a P of 30 for Microsoft, well, in a world where the discount rate's very low and the risk around Microsoft's growth is very, very low, I can actually justify that from a valuation perspective. The problem is you're paying 30 times revenue for a lot of the SaaS competitors, no earnings and 30 times revenue. Now that's where I struggle, and that's where I think the bubble is definitely formed. Statistically, you can prove it's a bubble. I think you can statistically. So then it's just a question of what actually triggers that? I have no issue with the longer term fundamentals of the world will use a lot more software, and you want to be exposed to that. And but I do think it will be a winner takes most outcome.
Give me the next big event that you're watching out for, and a stock that we should be watching over the next little while. Geoff, let's start with you.
Okay. Why don't I start with the stocks?
Oh.
Yeah, because I mean, we definitely think in Australia, what we do is we try to buy undervalued growth companies and buy them when we see a catalyst is going to change the valuation of the company. We think that it is time to embrace the Australian reopening trade, and for that, whether it's you look at travel, I think Australia spends something like $40 billion domestically and $50 billion on international travel. Now, obviously, the international travel is probably off for a period of time, so that 50 billion is probably going to be more utilised more domestically. And some of those companies, the big leader there, say Flight Centre, they've done an exceptional job getting costs out. The probably more smaller ones that we like in there are the likes of the Sea-Links, on a PE of 17 times and growing at 30% per annum. That's the ferry play over in Kangaroo Island, also buses here, and tourism holdings are two we like there. And then also housing. We think with these record low interest rates, the housing sector is cheap, and the likes of the direct plays, or the more direct plays there, are like the brickworks and say the CSRs, but the mortgage broking business AFGs, trading on about 12 times. So that's they're a couple of the plays. In terms of the next big event, obviously. What do I really worry about is all the liquidity being pumped into the system and interest rates backing up. But really, our feeling is it's probably 3 to 5 years away. Obviously, I'd keep a really close eye in interest rates backing up, and probably I think the election, the US election in the short term. Will be significant. And probably one of the interesting things to look at, I was taught I remember the 80, I started in the market in the 80s, and I remember the 82 recession. And we have had, in some areas, there's no doubt, well, we are in recession. And what you do find is companies have a fantastic ability of reducing their costs and their cost structure. So when revenue does come back, you really get a very leveraged earnings growth there. So to me, that's just a little, that's just something to be aware of.
Great point. Great point. Ben, a stock to watch and your next big event that's keeping you up at night?
Okay, well, I think the next big events in the very short term, I think in the United States, market sentiment will be dictated heavily by the stimulus bill that has yet to get through the House. I think that is an issue that's niggling at the market. It's niggling at investors. And I think we need to see a secure passage of the stimulus bill through the US, and that has been problematic to date. We need to see that. Following on from that, ahead of the election, I think is the reporting season, third quarter reporting season in the United States. Companies will start reporting in the third week of October. No one's really talking about it. We're going to get live information and data as to how corporate America is faring. Are we getting corporates being set up for the next for 2021, which I think is going to be good in an earnings sense in the United States. My earlier comments on a mini spending boom that coming. So I think they're the two big events ahead of the election. The stimulus bill's got to get through without too much fuss, and we need to have a satisfactory US reporting season, I think, to set investor expectations right for 21. So that's important. Look, stocks, Geoff touched on a couple. I'll give you two. One is naturally, like everyone, we're all spying the reopening trade. Where do we place a bet on that? There's one stock that we have bought progressively through the challenged market back in March and April, and then we've bought it periodically through this rallying market, and that's Auckland International Airport for a whole bunch of reasons. We're on the record on various media about saying this, but monopoly operator in a tremendous market with no curfew, and there are extraordinary managers there. So we think Auckland's, who I think if we can get a bubble between Australia and NZ, and if they can get back their other Asia Pac travel, they can be back at 75% of pre-COVID levels fairly promptly. So like Auckland's. And the other one, which is not quite in keeping with the recovery theme, but all the same is a turnaround story that will benefit from consumers increasing parsimony, of course, is the Reject Shop. It's a stock that I know is near and dear to the guys at Geoff Wilson's shop. Reject Shop was a classic turnaround. It's pitched at that end of the market where cost-conscious value consumers will dwell. They're doing a ton of smart things and merchandising and remodeling of the business. So we like Auckland International Airports, and we love the Reject Shop, and we're bullish on the markets through 21.